Here are the 4 absolute best ETFs you need in 2025 if you want a portfolio that just works without constant guessing or stress. I get it. Investing in the stock market as a beginner can feel complicated and overwhelming. Too often, beginners dive in picking stocks, chasing trends, and trying to time the market, and most end up losing money or burning out. That's why today I'm sharing the 4 ETF pillars you need, ones that give you broad market exposure, stability, dividends, and serious growth potential. No more guessing, no more stress. And I'll also share alternatives for UK investors too. Let's get started. First up, we have an S&P 500 ETF. This should be the foundation of any long-term portfolio. It tracks the top 500 companies in the US, giving you instant diversification across different industries. In the US, Vanguard S&P 500 VOO is a great choice. In the UK, you can go with VUSA or VUAG. Other alternatives are SPDR S&P 500 SPX5 or iShares S&P 500 CSP1. Having an S&P 500 ETF provides consistent growth over time, averaging around 10% annually, and resilience during market downturns as strong companies tend to recover. Even during inflation, many of these companies can pass on costs to consumers, maintaining profitability. If you want reliable long-term growth, this is your go-to ETF. Next, we have a dividend ETF, which focuses on companies that consistently pay dividends. This adds stability to your portfolio, especially during downturns or market crashes. In the US, SCHD is a strong pick. The UK alternatives are USDV or UDVD, also by SPDR. This ETF is particularly useful in times of high inflation or recession because even when stock prices fall, you're still getting passive income through dividends. Also, dividend stocks are more stable, which helps in market crashes. For those looking for higher growth, the Nasdaq 100 ETF gives exposure to the biggest tech and innovation companies known as the FANG or Mag 7 like Apple, Microsoft, and Nvidia. In the US, the best choice is Invesco Nasdaq 100 QQQ or QQQM. The UK alternatives are EQQQ or EQGB, both by Invesco. Other alternatives are Xtrackers Nasdaq 100 XNAQ and iShares Nasdaq 100 CNX1. The Nasdaq 100 ETF thrives during innovation cycles. When AI, semiconductor, cloud computing, or biotech sectors grow, so does this ETF. The Nasdaq 100 has also outperformed the S&P 500 in recent years, making it a strong long-term play. However, it can be more volatile, so it's best as part of a balanced portfolio. Finally, we have a global ETF which provides exposure to companies across the world, not just the US. This is crucial because different economies perform well at different times. In the US, you can go with Vanguard Total World Stock ETF VT. UK alternatives are VWRL or VWRP, both by Vanguard. Others are SPDR MSCI All Country World ETF ACWI, iShares MSCI ETF SSAC, and Invesco FTSE All World ETF FWRG or FTWG. A global ETF like VT is particularly helpful when the US stock market slows down or faces major correction. If the US struggles but Europe or Asia grows, you still benefit. A global ETF also ensures diversification across different countries and sectors. Now let's talk about why the 4 ETF strategy works in any market condition. Stock market crash, your S&P 500 ETF VOO will recover over time, and your dividend ETF SCHD will still pay you. High inflation, the S&P 500 and dividend ETFs hold strong companies that can pass costs to consumers. Tech boom, your Nasdaq ETF QQQ captures high growth opportunities. US slowdown, your global ETF VT ensures you have exposure to growing economies elsewhere. With these 4 ETFs, you don't need to constantly buy and sell. You just hold and let the market do its job. There you have it, the 4 ETF pillars that give you growth, stability, and diversification without overcomplicating your portfolio. If this video helps simplify your investing strategy, make sure to like and subscribe for more investing content. And let me know in the comments, which of these ETFs do you already own? Thank you so much for watching, and I'll see you in the next one.